So today we're going to talk about the basics of the corporate tax planning. So in the previous session, we went through, we went through the corporate tax and how this works. We understood that technically, when you make money in the corporation, your money is taxed in two different stages. The first stage is the corporate tax. So let's say this is your bucket and your money pours into that one. So you pay corporation, and you pay corporate tax. Do you remember what was the rates? 11%, 27.
27.53, and I don't remember the last one.
Yeah, 50.33% and 0. So that's for the tax-free part. So, but in general, the active income that you make in the corporation is going to be taxed at 11% or 27%. So first time you pay tax here, then imagine there is another bucket here. This is your personal income. Now it's individual tax. This is called change my pen. I think that this pen. So then it's another bucket is individual tax. That is based on the brackets and everything that we know. So then the money pours from here. Let's say that we made a tap here, and now this money pours into this here. So the first thing about the corporate tax planning is that the corporation is technically a vehicle to change the nature of your income. So what income goes into the corporation? It's the business income. And from the tax side, we know that personally business income is 100% taxable. And if it pours into the individual tax, you need to pay what? You need to pay CPP for that. CPP almost 12%. Up to 12%. So, but when that business income goes into the corporation, then you take out the money. What here it's called dividend. Now, for dividends, there is no CPP here. So immediately you're saving, how much you're saving? About 10% on your income. The other thing about the, hold on a second, I'm just sharing my screen. My screen now sharing. Okay, so I want to show you something that is very important, and I want you to learn how to play with that. Because a lot of time, this simple thing that I want to show you is gonna make huge changes. So you can search simple tax calculator. You see, I always use it here. Okay. So go to the simple tax calculator, and let's say the person lives in BC. So if the person make a self-employed income, a business income on the of $100,000, look at here. How much is the total tax that they have to pay? $27,000 almost, plus $8,000 CPP. So it's gonna go over to $35,000. So the total of income that will go for this one is 35%. Now, imagine the person put this money in the corporation. Use the same business, but it's incorporated. Now, In the corporation, they have to pay how much tax? It's less than $500,000. It's 11%. You agree with me? So 11% of that one is gone. So how much is left? $89,000. Now imagine that $89,000 is considered as an ineligible dividend. So how much is the total tax? 10,465. How much is the CPP? 0. So in general, they're gonna take home $78,000. But in the other scenario, the take home would be how much? Would be $73,000 minus $8,000. It would be about $65,000. Make sense? So with that, putting that money in the corporation and taking out the money as dividend, we are technically saving around $10,000, about 10% on taxes. So you see the tax planning opportunity here? And when you are an advisor, this is what exactly I did for a client of mine. The guy came to me, and the guy was an acupuncturist, and his wife is a kinesiologist, and both of them, they had self-employed income, and they paid self-employed tax. So what I did, I suggested them to incorporate. And when they incorporated, they almost saved $2,000 a month on taxes. You remember that I said that in Canada, if you cannot save on taxes, you mostly do not have any money left for saving. So with this simple strategy, by incorporating and taking out the dividend, they were able to build a retirement plan for themselves. So you remember the three different levels of advisors I explained to you? Yeah, Preeti, do you remember that one?
Can you please explain one more time? Because I'm new.
Yeah. So, we have 3 levels. Preeti, explain it to us.
I forgot it.
0. Yeah. Do you remember that one? Level 0 advisors, they provide just products.
Level 1 and level 2.
Yeah. And the level 1, advisors, they provide plan. And the level 2 advisors, they provide the strategies.
Yeah.
So, that's what I showed you is like a level 1 or level 2 even, a level 2 advice. Because technically you are saving them, you're retiring them with the government of Canada's money. Because if they were just paying the tax as an individual, that money would go just to the government of Canada. These wordings is something that you can use when you are promoting your plans to the people. Because, just you talk to people and you said that, yeah, when you get to the age of retirement, the maximum that you're going to get is about $1,000. And now I can help you to retire yourself with $5,000, $6,000, $7,000 monthly income without putting any money out of your lifestyle. You can keep your lifestyle, but get retired. So, this is a strategy that you can do when you are planning for the future. So, are we good? Is it clear? In this strategy, we are changing the nature of income from business income to dividend. Business income, 100% taxable, CPP. Dividend is less taxable and what? And no CPP for them. Are we good? So the other thing here is, let's say that the business is going very well. Now the person just needs how much? Just need that $89,000. Yeah. That $89,000 I'll explain. But the input is now $300,000. So how much is left there? So let's say that $300,000 is there. They have to pay $30,000 tax. And the money that is left there is $270,000. They paid themselves $90,000 like dividend. So it's $180,000 is left there. Okay, does that make sense? I see some confused pages. I see some confused faces. Are we good? If you feel confused, I can explain it again. So let me just write it more here. The income has increased up to $300,000. The business went well. Now they have to pay taxes. Let's say that they paid $30,000 tax to make it just more easier to understand. So how much is left? $270,000. And they paid themselves $90,000 dividend. So how much is left in the corporation?
180.
180,000. And now they have invested this money into the business and expand their business. So if they were a restaurant, they opened a new branch. So the money is investing into the business and it's growing. Now, what will happen? Down the road, this money, this expansion in the business is accumulated here in the corporation. And now they want to do what? They want to take advantage of that growth, that, non-distributed money in the corporation. All that $180,000 that is left there, they want to take advantage of that. Okay, so what's they're gonna do? So let's say over 10 years. Now the money that is in that one is $1.8 million. Make sense? Good. Now, this guy can sell the shares of the corporation to their next generation. So let's say that Mr. A is the owner of this company. So, and he has a kid. I'd like everyone to have a daughter. He has a daughter, and then he wants to transfer the corporation to his daughter. So he asked his daughter to register a new corporation. So it's Miss B. And now he sells the shares of this corporation to this one. So this corporation will become the owner. And then he gets the check and notes receivable from this corporation, and they're gonna pay for that one. So that $1.8 million thing there goes into his pocket. Make sense? Now, $1.8 million, $1.25 million of this money is tax-free. They don't need to pay any tax on them. And he needs only to pay tax on $550,000.
Is it by law that they don't have to pay 1.25?
Yeah, it's called lifetime capital gain exemption.
Mm-hmm.
So it's exempted. So first of all, he enjoyed lower tax rates during the time that he was expanding the business. Then He transferred the ownership of the corporation to his daughter. So everything stays in the family, stays in the business stays in the family. And then he took the money out of that corporation as tax-free without paying tax. So in general, overall, he has saved a lot of taxes. And he's now retired with this $1.8 million. He can gradually get the money and pay the taxes. Are we good?
He
Is
took
it
it
clear?
out. She took it out as a dividend.
No. He took it out as the proceeds of the sales of the share. He sold the share to this company, company B.
Oh, share.
Yeah, he sold the shares. And he gave them the shares and get what? Get the cash back. And the cash is the money that was sitting in his business, was the result of 10 years working in the business. They took it out. It's called intergenerational transfer. And it's a tax-free transfer. Are we good? So you see, when it comes to the corporation, I don't want to jump into very complex situations. But the first strategy, simply, you can use dividend instead of what? Business income. So you will avoid the first of all CPP, then you pay lower taxes.
I have a question.
Sure.
Is it just like one time in a life thing that they can do, or is it
1.25 is the lifetime. They can
okay?
use it several times, they can exhaust it several times, but the total amount that they use cannot go over 1.25.
25. But like even if they wanna, so let's say the person has that much of the money to sell the share for the second time for the same amount, and then they have another 1.88 million. What's gonna happen to that?
They have to pay tax on that one.
So it's gonna be 53%.
It's the individual tax. 50% of that one is a capital gain, 50%
Yeah.
of it taxable, and then, for example, they get $1.8 million, and so $900,000 is taxable, and they have to pay almost $400,000 tax.
Does it apply to the public companies shares as well?
No, this is just for, they call it Qualified Small Business Corporation, QSBC. QS, Qualified Small Business Corporation. And it has some criteria. I'm not going to jump into that one. But I want to show you some ideas that how we can help people, especially if you move from this, level 0 to level 1 and 2. You can help them, provide them with a long-term strategy to take out the money, pay less taxes. Is it clear? The other way that you can build some opportunities for them to save on their taxes through the corporations is to, use some strategies that I talked about it in the previous session. You remember that confusing chart? It was about the 3 different scenarios to take out the money as dividend, buy the property inside the corporation, or use the whole life insurance policy as a mediator to take out the money. Okay? So I want to talk about this one as well. So before I jump into the conversation, I'd like to talk about debts. There are some points about the debts that are very, very important. First thing, which is the most important one, debt is always tax-free. You have never seen in any country in the world that they charge taxes on the debt. But the money, all the money that you get is going to be tax-free. And then when you borrow money, you need to pay interest. So it's very important to understand different types of debt. We have good debts and bad debts. What are bad debts? We call them borrow to spend. When you borrow money to spend it, go on a vacation, go on holidays, something like that, or pay for your lifestyle or anything like that. This is a bad. And even for the credit score, it's considered as a bad debt. For example, the credit card debt is a bad debt. But the good debt is a debt that you borrow to invest. So we talked about the mutual funds. You remember that one in our financial planning session? So imagine you have a mutual fund that pays you a return of 12%. Okay? If you borrow and pay interest for 4%, how much is your bottom line?
8.
8%. How much is your net investment? 0. Because you borrowed the money, invested the money, and then you got this number. So technically, if you divide, for example, let's say that I have $100,000 investment, I got $12,000, I paid $4,000 interest, so $8,000 is the balance. If I want to calculate the rate of return, I have to divide $8,000 by the net amount of investment, which is nothing, which is 0. If you divide anything by 0, what's going to be the result? Infinite, yeah? It's going to be, you're going to get an unlimited return. And you cannot find even a single wealthy person who got the money, who got the wealth from anything out of borrowing. Have you read that book by Robert Kiyosaki, Rich Dad Poor Dad? Have you read that one?
Yeah.
He talks about this one there. People, the only way that you can make, something like Elon Musk, huge money, you need to have huge investments. And to have huge investments, you either should find some gamblers or you should borrow money. And so the borrowing money to spend it has another name. It's called leveraging. So when you borrow to invest on a good debt, the interest is tax deductible. Anyone remembers the difference between deductible and credit? Who knows that one? Deductible, we can deduct the amount for tax deduction. We can deduct it from the income. So we're going to save taxes on the marginal tax rate, on the highest tax bracket. While for the credit, we're going to get something deducted from the tax that we owe. So it has nothing to do with the marginal tax rate. Let's say that the person is making $500,000 a year, and now his marginal tax rate is 53%. Now, if that person deduct $1, he's gonna save 53 cents on the taxes. If he deducts $100,000, he's going to save $53,000. So that's why you see deductions are very limited, especially for employees. It's very, very limited. And you cannot deduct a lot of stuff. So, but credits are mostly available, even for the dividends, you have credits for, personal amounts, everything related to that one, you have some credits. So if you know the strategy, the tax system, it's something that you put a tax-free money, let's say that you invest, you make an investment. The money that goes in is tax-free. You don't need to pay any tax on it because it's debt. Then you make income out of it, then you can deduct the interest. Can deduct it from here. And then, net income. And then you pay tax on the net income. You see, you save a lot on that. Now, the whole strategy about this whole life thing, I'm not going to jump into the detail of that one because you need to understand the dynamic of the whole life and how it works. But the whole idea is that I put the money into whole life. And then I get a loan against that one. How much is the loan? 100% of the money that I put there. Now, I use that money, that loan to buy a piece of property. Now, the interest that I pay on this loan is tax deductible. So let's say that this person paid $5,000 interest on this loan. Now they can deduct $5K interest. And then they would have $15,000 taxable income. Now they have to pay tax. How much was the tax? You remember the marginal tax rate is 40%. Now they pay $6,000 tax. And the bottom line is going to be $9,000. While if they bought it by their own money, not the lended money, the borrowed money, if they buy it by their own money, this number would be how much? $12,000. So they lost $3,000. While when you check the interest, it's $5,000. How's that magic happened? They spent $5,000 more, but the amount that went into their pocket reduced only by $3,000. How this happened? It's because of the deductible nature of the interest. So I want to introduce you to this concept. It's called effective interest rate. So let's say that we borrow for 5%. Okay? And that interest, that money is invested, so the interest is deductible. So, and our marginal tax rate is at 50%. So we're gonna say 1 minus the tax rate, which is 50%, MTR. So the result is gonna be 2.5%. How much is the actual money that we pay for this interest? Technically, not, on the contract is 5%. But in reality, we pay only 2.5%. Why? Because half of this number is saved on the tax. Make sense? I like your smile, Rahul.
It's like too much. It's like playing again the game, like you're doing this and then that, and
And so, you know, the whole idea is that when the interest is deductible, you're gonna save on that interest that you pay. Technically, you know, when let's say that your tax rate is at 50%, which is very common in people who make about more than, you know, $200,000, something like that. And so if your tax rate is at 50%, then the, on the contract, you're paying 5% interest. But in reality, you pay less because you save on your taxes. So the amount, the actual rate of return, the effective rate of return that you, sorry, the effective interest rate that you pay is 2.5%.
Because
Not,
it was loan, right? It was deductible
loan and
on
deductible.
tax.
So let's say that the person, the MTR of this person is pretty high. Let's say that the person income is 90,000. Well, it's less. It's 70,000, which is normal income here in Canada. So the MTR for this one is about 30%. So this guy has got a loan and invested the loan. So the loan is at 5%. How? The effective interest rate is 1 minus 30%. So it's going to be how much? 3.5%. So on the contract, again, 5%. In reality, they pay 3.5%. So it's very important that you as an advisor know that how to invest this money to get the maximum deduction. So I'm not going to jump into all those. These are something that you will learn when you want to become a level 3 advisor. But these are some ideas that can help you to help the corporations. And you know, people said that, you know, in Canada, you're cursed to pay a lot of taxes, but they don't know the system. If they know the system, they know that how they can save on their taxes and pay much less taxes. So, you know, tax planning is an industry that is never gonna go down. It's always gonna rise. So if you want to be a part of this industry, you're more than welcome. And you know, if you want to go in any other industry, you should always be worried about that the tax rates are going up. But if you are in the tax planning industry, you're always happy that the tax rates are going up, because you're gonna have more and more business coming to you. Okay? And believe me, in Canada, the tax rate will never go down. It has been constantly going up and it will continuously go up. Okay, so any question? I think